All right, well, why don't we get started? Hi, everyone. Welcome back to our weekly call here that we usually have. Um, Again, sometimes we have it, sometimes I'm busy and we don't, but this will be the third week in a row that we do have it. And today I have Gordon Coyle on with me from the Coyle, what is it? The Coyle Group
Coil
uh,
group.
out of New York, right? Is that correct? New York?
Yep.
And they specialize in business, all kinds of business insurance lines, and specifically we wanted to talk about today the basically reps and warranties insurance with the transactional liability private enterprise product specifically, um, which relates more towards which relates more toward I guess relates more to mergers and acquisitions, and transactional type insurance versus you kind of your normal commercial policies and what have you. So I'm going to let kind of Gordon introduce himself and the firm, and he has a short presentation to start with, and then we can kind of jump into the topic at hand. And you guys will feel free to ask questions along the way once Gordon is done with his particular presentation here.
Great. Am I going to be able to share my screen, or are you going to
Yeah,
need to
you should
give
be able
me
to share.
control? Okay. All right. Can you see that?
Yep.
All right. So thanks, Rich, for the invite. I appreciate it. And as he said, I'm going to keep this short. I tried to keep it down to 5 minutes. When it's done, we can have some Q&A if you'd like. And as he said, my name is Gordon Coyle. I'm the principal of the Coyle Group, an agency that my grandfather started in 1929. So I'm a third generation owner. We only do business insurance. We do business across the US. My office is in New York, but like I said, we do business across the United States because we have a very big digital footprint. We do a lot of content and we get a lot of results from that. So with that, I'm going to jump right into it. Thanks for the opportunity again. We're going to talk about reps and warranty insurance, which has been around a long time. It's very predominant in the middle market. I think the statistic is that about 65% of private equity deals deployed some form of reps and warranty insurance to help secure their deals. So what is it and why is it needed? Litigation risk is really the foundational need for R&W insurance, is what we call it, because litigation can arise from innocent misrepresentations made during a transaction and in a transaction document. The seller agrees to indemnify the buyer for losses they may suffer as a result of inaccurate representations made in the purchase and sale agreement. In the small business market, this product has not existed in the past. So what buyers have had to have done is they hold the seller's feet to the fire, holding back 10 to 20% of the deal in escrow for 2 years. But is that enough? The problem, probably not. The problem with escrow, as this slide talks about, is that it only insures a very small portion of the deal and what's at risk, and it's only held for 2 years, whereas the obligations in the purchase and sale agreement last for 6 years. So many disputes don't arise in the first 2 years, they'll arise in years 3 through 6, and those disputes over misrepresentation become a problem when there's no collateral and no insurance in place. Litigation is really the only resolution, which for the buyer is very costly and time consuming and emotionally draining for both parties. Time delays can really impact the buyer's expectations and their economic recovery in the deal. So insurance helps smooth that out and settle claims equitably and quickly for both parties. The other thing about collateral is that sellers, and I know most of your clients are buyers, but sellers absolutely hate leaving money on the closing table. And if you do the math, the time value of money on that collateral is about the same as the premium in many instances. So, and we'll talk about costs in just a moment. So insurance may make more economic sense. On top of that, I'm not sure that buyers like to have collateral much either when they consider how little impact it has when a deal goes sideways.
Yeah.
So why insurance? Reps warranty insurance provides much broader, much more effective coverage in the solution instead of collateral. Full deal value is insured for the full indemnity period. It helps reduce deal friction and provides a value add by removing the collateral and reduces credit risk for the buyer. I go into some of the other facts here. The insurance is typically split between buyer and seller, which is a nice feature. This one point I'm going to get to. I'm sorry. I'm kind of looking at my notes. Final bullet point, I think, is critical for sellers who continue to work in the business, helping during the earnout period. If there's a misrepresentation claim, it's going to be pretty sticky to sue that guy that's working to operate the business for the buyer. It'll contaminate the deal and spiral it out of control. With insurance, the claim is managed by an insurance company, and it really is kind of worked out and smoothed over to preserve that business working relationship. So on to costs. Let me just move some stuff around here on my screen. What does it cost? Currently, we have one product, and that's a seller's policy, but we can endorse that policy to include the buyer and protect the buyer. That costs about $12,000 per million of enterprise value that's insured. So as this slide shows, a $3 million deal, the premium would be around $48,000. A new product is coming out in about a month or two, and that will be solely a buyer's product. And the cost of that is $5,000 per million of limit purchased. So if you purchased the full value on a $3 million deal, the premium there is $15,000. We think that product is going to be very attractive for buyers. We still like the buyer and seller being protected, especially when collateral isn't going to need to be used anymore. The seller really is attracted to this kind of a product. Premiums are one payment. I've had some people say, my God, I got to pay this $48,000 every year. No, it's a one-time payment, and it's good for the full indemnity period. Deal sizes that we insure, we can go down to $250,000 of deal value, and for the right deal, up to $30 million. That's been expanded. This product was really geared initially when it was released about 2 or 3 years ago to cap out at about 15 million, but the underwriter has had some good success with it, so they've increased that, generally speaking, to 25 million, but for the right deal, they go up to 30 million. They've got a broad appetite of industries, but the underwriter shies away from any regulated industries, like I mentioned here: healthcare, financial services, energy. If you're working on a deal and you want to find out, gee, I wonder what this would cost, we can provide a premium indication, which is a very rough ballpark, by providing the name of the seller, the value, transaction type, where they're located, and what industry they're in. With those 5 pieces of information, and I can even put together kind of like a quick form to fill out if you'd like, and give you a link to it. We can turn that around in 3 days and get you what's known as a non-binding indication. That'll get you in the ballpark of where the premium is likely going to land. If the client says, yeah, let's do this, then we would need a full application, which is like 8 pages, a copy of the sale agreement, financial statements, and if the purchase and sale agreement's not done, a draft copy is fine. Then we can get firm pricing to you with full terms and conditions, and that can get returned from the underwriter in about 3 days as well. In the middle market, just to compare the 2 products, in the middle market, this usually starts off with paying a $30,000 underwriting fee, which doesn't happen with this small business market piece or policy. So it's intended to be fast, easy, and efficient, and I think that it's done that. Let me just go back. The underwriter, I don't know if I've got it in here. The underwriter is CFC, who is a cover holder in Lloyd's. So high quality policy, high quality paper, good underwriter, all good there. So why offer it to clients? In my opinion, I think it's a value add and it puts you in a good position with buyers. You want repeat buyers, and insurance helps facilitate deals and make it easier for them. Some buyers believe that deal risks are covered by their D&O insurance, which it does not cover it. D&O excludes contractual liability, so that would be excluded there. You want to guarantee that innocent misrepresentations don't damage your deal. That's the bottom line. So it helps facilitate deals. And with that, I hope I got it done in 5 minutes. I hope I didn't talk too quickly. My contact info is on the screen, and I'm sure that Rich can share it with you guys. I think it was also on the invite. At least my email was. So why don't I stop the share, and then we can have a little Q&A.
All right. I guess Adam already has a question. Good, Adam. What's that question?
Yeah, thanks. Great presentation.
Thank you.
So Gordon, two questions. What you mentioned there's two products, an existing one that is seller oriented and could include the buyer, and then a new one you're coming out with that is buyer focused. Can you describe the difference between those products from a buyer's perspective? Why would I be more interested in the second product other than cost?
Because it indemnifies just the sellers, or just would indemnify the seller for any claims they may incur. It doesn't protect the seller in any way. It only protects the buyer, and it's less expensive.
Okay. And then you mentioned D&O insurance. I'm not familiar with that term. Could you?
Sure. Sorry, I used an abbreviation, which is so common in our business. D&O stands for Directors and Officers Liability Insurance, which protects the leaders from allegations of wrongful acts and managing the business. That's where a lot of people think, oh, well, if I make a misstatement during or in the purchase and sale agreement, I'd be covered under my D&O policy because it covers misstatements, but not under a contractual obligation. So that's where it wouldn't be covered.
And that's on the seller side. The D&O policy would be more applicable for the sellers anyway, right? Not necessarily the buyers, because obviously the buyer isn't a director or officer of the company just yet. It would be the seller's comments that they think would be covered by the D&O policy. Yeah.
Got it. Okay.
So, well, let me go back to the chat. There's a couple questions before I jump in and start asking. So Lee asked, so this product is for non-fraudulent misrepresentations.
Correct. Innocent misrepresentations, any fraud is not going to be covered. Any known conditions that were known at the closing or in the document are not going to be covered. So you're not going to be buying insurance on a burning building.
Yeah. So it's basically, those are basically covered by legal statutes anyway. Within your, they're representing that certain statements are true about the business, and if they're fraudulent to begin with, then they're just breaking the law. So there's legal remedies as opposed to insurance remedies from that.
Right. And there are going to be exclusions in the policy, like environmental liability is not covered. Accounts receivable are not covered. Like I said, known hazards are excluded, fraudulent acts. But, areas where these things can go sideways in a deal are potential unknown tax liabilities, potential IP violations, potential cyber risks. Cyber has and we do sell a lot of cyber insurance, but cyber can be insidious and be in somebody's business, affecting it for months, if not a year or two, during transactions. So that's a particular risk that the buyer is now assuming that private data has been infiltrated. So that would be something you'd be concerned about as well.
Okay. So at the premium, let's just say we're talking about the kind of the new product that's coming out. It's 5,000 per million of value, what have you. When you pay, let's just say on a $3 million deal, you pay a $15,000 premium. Is there like a deductible that we then have to kind of absorb before that policy would be paid out?
There is going to be a deductible, and that changes with every deal.
Okay. And how is that determined? Just by the risk assessed in the deal?
Yeah,
or?
what the underwriter's sense is of the deal and how much risk they want. If it's the second product, how much risk the buyer should be assuming in the deal. I don't know how that second product is going to be structured in terms of deductibles just yet.
Okay. And the first one, it's kind of, understand kind of how they structure the deductibles around that.
Yeah, it's typically going to be, I think the most times we're seeing low deductibles in the area of $10,000. So it's pretty affordable.
Okay. Okay. And the policy covers how many years you said? Like 6?
6 years. So the full
6 years.
indemnity period.
Okay. Okay.
In Europe, it's 7.
Oh, they get the value of the extra year there, huh? Let's see. Okay.
Oh, Ryan's got his hand up.
Oh, Ryan, go ahead.
Hey, thank you. So question on that 6-year indemnity period. Is that something that's, I guess, an industry standard or kind of legal terms for this type of business? I'm not familiar with that. Could you just elaborate on how that's put together and how?
Sure. I think that it has to do with statute of limitations in contract law. I'm not a lawyer, so I won't comment on that, but I just know that the typical indemnity period in a purchase and sale agreement is 6 years. So the policy matches up with that.
Is that something we'd have to kind of ensure we have in our contract language, or is there more like just kind of case law that supports that type of situation?
I'm not sure. I would think that it's in the contract. Anybody else have a comment on that?
Yeah, I'm not sure about that myself. Something we probably have to ask our attorneys.
And I guess just to build on that too, if we wanted to either shorten or extend that window, is that something that you can write into your policy and adjust a premium accordingly?
Not to my knowledge. I think they are only going to do it for that known indemnity period.
Okay.
It's
All right.
fixed.
Thank you.
So what happens when, there is a breach, and you have to file a claim? Kind of what does that process look like? Is it an easy process? Is it something that takes we have to spend, we have to write a 5,000-page document to submit to the insurance company? Kind of how does that process work?
Well, like any insurance claim, you're going to need to substantiate the loss. If you just have a bad feeling like, oh, I'm losing money on this deal because I don't know why, that's not a valid claim. But if you said, well, I didn't know that there were employment claims that could be potentially arising here. Let me think of a better one. Of course, off the top of my head, I can't think of them because I have a whole list of them in my handout material, but I can share them with you later. But if you had a valid claim because of a misrepresentation, you would have to document it, send it to the insurance company and file it like every other type of insurance claim. And then they would do the investigation and then they would settle it. And your settlement is going to be your financial loss as the buyer that you suffered because of that misrep.
Okay. All right. Does that mean that then our attorney would have to I guess I'm trying to figure out exactly how would we assess the loss. Is that something that's like documented by an attorney or documented by some outside party to provide veracity behind that? Or is it something that we just kind of document based on what we assume are the losses, and then the insurance company will investigate and then come to some sort of conclusion? I guess.
No, it's going to be more of a case of hiring a forensic attorney to be able to uncover
that's where I'm going.
Where those losses are, and then what the future value of those losses are going to be. And then it's going to be, back and forth with the insurance company. They're going to want documentation as to how you arrived at a particular number.
Gotcha.
There's a question, who is the ultimate company underwriting these policies? The ultimate company is CFC, which is an underwriting facility within Lloyd's of London. That's what cover holder is. Has there ever been any suits between an acquirer and the insurance company, meaning for failing to pay a claim or a bad claim handling practice or something like that? Is that what you mean?
Lee, is that what you mean?
Yeah, sorry, failing to pay a claim that was thought to be insured but wasn't. And I'm not talking about, I guess, something stupid that the buyer just missed.
I don't know. I'm not privy to that. And I bet if I asked, I wouldn't be told if it did exist or not for privacy purposes.
Yeah.
Understood.
Is there like a max loss on these policies that the insurance company is willing to pay? So like, let's just say, I don't know. Let's be ridiculous here. Let's say you buy a business for $3 million and all of a sudden you realize, hey, I lost $3 million because of innocent misrepresentations. Of course, that wouldn't happen, but is there like a max loss that they put on these policies?
Well, it's a good question. In the middle market, the reps and warranty policy usually is not the full value of the deal because those deals are going to be $600 million. It would be very, very expensive. Yeah. So they kind of allocate a certain amount where they think their risk is, and that's what they buy the insurance on. In this product, the full deal value is insured. So if the entire deal goes down the tubes, you're going to get paid for the $3 million.
Okay. Okay. Oh, that's
so the cap is the limit on the policy.
Okay. All right. That makes sense. So,
and in the new seller's policy, I've indicated here that it's $5,000 per million of value. Mm-hmm. But I actually think that's wrong. I think it's actually $5,000 per million of limit purchased.
Okay.
You don't need to buy a full value policy. If the buyer says, look, I only want to hedge, this is a $10 million deal. It's a big deal for us, but I only want to hedge the first $3 million. I think they can do that in the new policy. It's not fully developed yet, so I don't know all the details.
Okay, that would be the $15,000 then for that particular exposure that you're trying to cover,
right?
As opposed to okay, all right, that makes sense. So, what would be the instances, just to kind of bring this to a level of practicality for our acquisition entrepreneurs? They're out there, they're looking at these businesses, whether they be home service businesses, construction related trades businesses, whatever. They're out there, they get an LOI on the table. The LOI is accepted. When would they necessarily either contact you, or kind of what would be, maybe you can give them some insight as to when would they think this might be appropriate or not appropriate? Like where would the decision point be? So I guess there's two questions. How do they determine if it's worth it to buy the insurance? And the second question would be, when should they contact you if they're interested in purchasing a policy?
So we've worked in different stages of the deal, and because the turnaround time is fast on this, unlike the middle market product, we've had transactional attorneys contact us like, hey, we're going to close a deal next week. Do you think we could get a policy in place? Now, the problem with that is that the underwriters, their ears go up because they're like, oh, what's going on here? Like now they need a policy. But if you provide all the documentation and it's all legit, and the attorney says, it just kind of crossed our minds that this may be a good fit for this policy, we can get it done. We've also had deals where it's like in the early discussions, letter of intent, non-disclosure agreements have been exchanged, and they're still early on in the negotiations. The agreement, the sales agreement, hasn't been drafted yet. They still want it. They may just want to know, what is it going to cost? And I think that may be the best way to go about this. With the transactional attorneys that I'm working with on this, I'm like, don't worry about like wasting my time, because it's really just forwarding a form to my underwriter. Then when they send it back, reviewing it, making sure we've got all the terms and conditions we want, and sending it on. It may make sense for you folks that if you've got a deal and you just want to see what it is, I'll like I said, I'll send Rich a link to a form, and you can just fill out the form, send it in to me, and we'll give it a shot. And if it's like, oh wow, that's like too expensive, no problem. Or that's pretty good. What do we need to do next? And then we could just start to acquire more information. I think that's probably the best way to go about it. That's how it's worked with the attorneys I worked with on this product, because nobody knows, is it worth it or isn't it worth it until they know what the premium is. That's
Mhm.
kind of the decision point, and how much appetite a buyer is willing to assume. And on this, if you're buying a combined policy and you're thinking, okay, Mr. Seller, $3 million deal, I'm going to hold back $300,000, and he's either retiring or starting a new business. That $300,000 is a lot of money for 2 years. If you knew that the insurance was X dollars, it may be worth it. It may make economic sense for the buyer to engage on that, and the seller tags along and says, I'll pay half of it. I'll pay 30% of it, whatever.
So you can almost, from this standpoint, like if you're negotiating with a seller on a deal, and they've had other offers, and they know kind of the market, maybe the brokers indicated to them that, hey, typically a seller is going to hold back, they're going to want to hold back reserve, $400,000 or $500,000 in this deal. It's almost like you could use this potential policy, maybe even split the cost with them, from that standpoint, and use this policy as a way so that they don't have to worry about that $500,000, and it actually closes the deal for you. As opposed, okay, all right.
I think it's a goodwill tool.
Yeah.
I think it helps grease the wheels a bit.
I have a question. I don't know how to raise my hand on this on Zoom. I have no idea how to do that. So my question is, so you said 5,000 per million that you want covered, and then you say, well, we need to get a quote from the underwriter. So is it just ballpark 5,000, then dependent on, is it like, and then since it's your reps and warranties, is the cost of the policy going to be determinant on what your actual reps and warranties are? And then, or how does that, where's the cost variable, I guess,
Sure.
right?
So what I did is I made the pricing the average of the range, the median of the range of what the premiums are. So to insure both the buyer and the seller, the average cost is $12,000 to $20,000 per mil of value. So I gave you the range. On the new product, that's a flat charge, I believe. So what determines the final premium is going to be the industry, the deal structure, the location. For example, California is surcharged because there's so much litigation in California. The same way that like employment practice liability insurance is so much more expensive in California than anywhere else. Those are going to be the factors that go into determining the premium and the size of the deal. Did I answer your question, or did I get way too off track?
Yeah, so you kind of did, I guess. So what are what additional do we look at here, I guess, right? So if it's 5,000, right, you said it might be flat fee, and let's say it's in California, and you probably don't know yet. So you're saying this is all going to be hashed out probably once it's all finalized.
Yeah, that's in the seller. I'm sorry, that's in the buyer only policy. In the combined policy, that range of premiums that I gave you is kind of the high and the low. And in most of the deals we've seen, they come in on the lower side.
Okay, and then so you guys, this is insurance for your reps and warranties, right? So it doesn't matter how many we have, or is it a limit? Let's say obviously that's a game, right? So getting them to actually agree to those, but if we had 50 versus 25, right? Or do you only insure certain ones, for example?
Yeah, so they're going to generally insure the reps and warranties as stated in the agreement. But if there's something that's got like a lot of hair on it, they may ask a lot of questions and say, you know what, we're going to carve that out. And that's all part of the negotiations of buying a policy. we haven't seen that yet, but I just know from the underwriter's perspective that if there's something particularly dangerous, that they're going to put it on the exclusion list.
So will we know ahead of time? Sorry, James.
Oh yeah,
you're done.
So
will we know
yeah.
ahead of times so we could go back to the seller and say, hey, we're going to do a holdback for this piece of the reps and warranties just because we couldn't get insurance on it.
Right. So what's going to happen is you'll get that preliminary indication. That's just to give you a ballpark idea of what the premium is, what the limit is, and what the retention or deductible is. You're not going to, from that document, you're not going to get all your terms and conditions. If it says, oh yeah, this looks interesting, let's take the next step, and we aggregate all the data, send it into the underwriter, then we're going to get a full offering, which is bindable, back. And that's where we're going to find out what it is and what's not included.
Okay.
You're going to know that well before signing up for it, for sure.
Okay.
And what's the timeline on that? So you said it's pretty quick to get the initial.
Yeah. So the initial one is 2 to 3 days. And
Yeah.
after you give me all of the data and I get that over to London, they return that back to us typically in 3 days. And if it's needed faster, like if you're like running to the closing and you need this in a day, I could, and time difference, between here and London screws us up a bit, but I can put a rush on it and I can get it done usually in a day, maybe 2.
Okay, and then I guess my last question would be fraud. So you said fraud is not covered.
Right.
How is fraud determined, right? So if the seller is calling, willful ignorance or blissful ignorance or whatever, like they say they didn't know, or they say this, do they have to admit that they knew something, or so where's fraud? Where's the line here?
Yeah, that's a good question. I think that if there's a hint of fraud, if there's an allegation that there was knowledge of a circumstance that gave rise to the claim, there's going to be an investigation. So I mentioned directors and officers liability insurance briefly before. And in that policy, there's a statement that says, before the officer of the company signs the application, do you have any reason to believe that there's a situation, a circumstance, or anything that could give rise to a claim under this policy? Yes or no. They check a box and then they sign it. If they say no, and then 6 months later a claim happens, and the underwriter's like, wait a minute, the circumstances of this claim lead me to believe that you did have knowledge, therefore it's not covered. They're going to investigate, and they're going to want to uncover a lot of stuff. And it could be email trails, it could be conversations, who knows how they're going to investigate it. But when there's a lot of money on the line and the insurance company senses that there's a fraud, they're going to want to investigate.
Okay, and that's not our burden to bear, so to speak.
It's not yours nor mine. It's
right,
we're collecting information. Yeah, and the application is geared in such a way that it's very clear that like you have to disclose what you know and what you don't know. And if you don't, you're gonna end up in a situation that you're gonna have an uncovered claim. It doesn't, and I try to tell clients this all the time, it does you no favors to kind of white lie or just get too close to the line. If you think that there's a reason you could have a claim under this policy, disclose it and let's work through it. I'd rather have it, known and acknowledged and either carved out or included based on the underwriter's response to that.
So, and
go ahead, James.
When I say that, I don't mean me, right? So I mean as a buyer, right? So,
okay.
So as a buyer, you're buying, and then let's say, who knows, tax, whatever, like kind of like you said, right? Or so if the seller he says, oh yeah, I didn't know about that, right? Like, oh, well, I had no idea that whatever indemnity that I, whatever it is, and he doesn't admit that he ever knew. That's where I was like, okay, so when is it fraud, right? When do they say, okay, you're a liar, right? You're full of shit. You knew this. Excuse my French. Or is that just, again, the underwriter's they're gonna be like, we think this might be fraud. They're gonna do an investigation.
That's usually how it's gonna go.
And then you might get screwed either way.
Yeah,
basically.
yeah. So it makes sense to disclose everything up front.
Gotcha.
So what happens then with the new policy, which is a buyer-specific policy, versus the traditional policy, where the seller is actually signing off and saying, "Hey, these are all the known issues or what have you, or this is what I know. In the buyer policy, I would assume that they're not necessarily doing that. So how does that work for the new
So in the
policy?
seller's policy, that's a good point. In the seller's policy, they're making representations to what they know about the deal. And they're not really, they have no real insider knowledge to the operations of the company. I'm gonna have to get back to you on that one because I'll make a note on new policy.
That's what I was so he said it exactly what I was trying to say.
I think I was the one that fouled it up. Sorry, James.
Yeah, so that's what I meant is like what happened because they're not certifying anything on the buyer policy, right? Or for somebody who's buying it versus the seller, the other one that exists now.
Right. I think just off the top of my head, I would think that there's no way that the seller could be held liable for any misrepresentations made by the buyer. I'm sorry, I got it confused. There's no way the buyer could be held for misrepresentations of the seller in a buyer's only policy.
So they're going to really lean on that reps and warranties, and basically, I guess it all comes back to legal liability, because if it's just innocent misrepresentation, the policy covers that. If it's fraudulent, there's legal statutes that cover that. So ultimately, if it's determined that it's, if the underwriter determines that it's fraud, even on the buyer policy, then we have legal remedies to go after the seller anyway. So I guess it ultimately will work itself out. But I was just curious as to kind of what the mechanism would be, given that the seller probably doesn't represent or sign off on anything on the buyer policy.
Right, and I'll get back to you on that. Mark has
Mark?
a question.
So,
Hello. I have the question is, what percentage of the company do you cover if somebody do they have to have 100% ownership, or if they have like 51% ownership of the company you buying, like if there's two owners and you buy 51% of the shares from one owner and the other owner keeps 49%?
I've not come across that. That's a good question. So you're talking about buying a majority interest of
Yes.
an existing company, and the existing ownership structure just changes to that. I'll have to get back to you on that one. That's a good question.
Okay. Thanks a lot. Appreciate it.
yeah, it's almost a recapitalization situation. Anyone else have any other questions? I think I'm this is interesting. I didn't use it. I wanted to. Had I known about this, I mean, I actually didn't learn about this insurance till probably about 6 months ago, maybe a couple months before, or 3 or 4 months before I actually reached out to you, Gordon. And I was involved with a much larger transaction, and one of my partners basically suggested that we use reps and warranties insurance for that transaction we were working on. And I had never used it. I actually had never even thought about it. I had never even known that there was a mechanism for something like that, because we'd always use holdbacks in our contracts. And so this, had I known about this, and had I known about it from actually a small company level, I would have definitely made use of it. I mean, when I bought my company, I still had no idea about it. But going forward, for sure, this is something I think makes a lot of sense in terms of just de-risking kind of the pitfalls with a deal. And it just kind of makes everything go smoothly. I think it helps the seller from their standpoint, where we're not holding on to a bunch of cash, but it also just gives me peace of mind to understand that, hey, if there is something there, we can speed up. I don't ever want anyone to think that you don't want to do your due diligence. You still need to go through that process. But at the same time, maybe there's a way that where, you're going to come across information, and rather than kind of, spending too much time on that particular item, you just include it as part of your reps and warranties, and you just have them certify it, and you just move on. And I think it just kind of speeds up the transaction from that standpoint, because right now, I'm coaching a few people through transactions right now. And as we get to the back end of that process and we start to review the reps and warranties, I'm reading those very thoroughly and carefully, and I'm going back. Hey, you're warranting this or you're repping this, but I didn't see anything about this within the documentation. It looks a little bit different. So now then you're having to go back and they're trying to, it just creates a lot of problems from that standpoint, or a lot of time delay. So I think this is definitely something that's worthwhile. And yeah, if you want to send me that link, and I can definitely provide that to the group as they're out there and they're, bringing deals under contract.
There's a couple more questions, and then maybe we'll jump over to Ryan. From a purely curiosity point of view, these policies bundled and sold, or are they kept on the insurer's books? Do you mean like how mortgages are bundled and sold, Lee?
Lee, you there?
Well, I'll just answer the question. If he's thinking that like how mortgages are bundled and sold off into different secondary markets, no, these are held on the books of the insurance company, especially since there's only one premium payment.
That's what I was going to say. What benefit,
elsewhere.
what benefit would an investor get from just buying the risk?
Josh Perry asked, is the policy cancelable if the deal falls through? Yes. And are you seeing buyers bundle the insurance policy in their SBA funding? I'm not positive about that, but I did read recently something about that. I don't know. I wasn't clear on it, but it may be that was the issue. And finally, Lee also asked, juiciest, I think, story of accidental misrepresentation. I'll send Rich a flyer from the insurance company. It's got a few stories in it that he'll share with you. And then, not to take up too much time, but Ryan, what did you have?
Yeah, so I got a question that kind of builds on Rich's point about due diligence too. So from the perspective of a buyer and a buyer's only policy, where is kind of the insurance company drawing a line between coverage for various aspects of a deal versus a buyer's responsibility to do their own due diligence, right? And where do you kind of would say, hey, I want to make a claim because I've got an issue. This was warranted. I didn't uncover this problem during my due diligence period. Where do you say, hey, Ryan, like you really didn't do your homework here. We're not going to cover this because this should have easily been uncovered in a deal versus saying, this is legitimate.
Yeah.
There's no way you could have known this. Here's the payout for the difference.
That's a good question. I don't have an answer to it. All I have so far from CFC on the new product, the buyer only product, is the policy form as it's been developed and the pricing structure, but we don't know a lot about the underwriting and how claims will be covered. But I agree with what you're saying. Where does it end? Like, oh, let's just buy an insurance policy and not do any diligence. You're like,
Yeah.
This is a lot cheaper than diligence. And I'll just make a quick comment on that and a plug for myself. If you ever need an expert to do risk diligence on a deal, I've done that. I've worked in the private equity space doing diligence work, so I'm experienced there, and I'm pretty reasonable fee wise. So you can use us. And in the middle market, risk diligence is done almost on every deal to kind of pinpoint the holes and the gaps and the issues that are in the seller's insurance program and their risk program. Mm-hmm. But I think that's a great question, and I'll see if I can't get some more info on that for you, Ryan.
Thank you.
All right, Rich, I didn't want to take up your whole meeting today, but I hope it was a good conversation.
Yeah, you were scheduled for the whole meeting, so don't worry about it.
Okay.
And usually if I have a guest and we finish with the questions, that allows everyone to jump off earlier than what they usually would anyway. So do we have any final questions for Gordon?
Yeah, one question. Are there any other interesting small, like lower market, sub $5 million insurance programs, I guess? Is there any other things that you can insure or that you are insuring outside of this new product, I guess?
In terms of reps and warranties?
Just in terms of any insurance product related to buying a business.
Offer any other service lines is basically.
So one of the key things that happens during a transaction is if the seller has errors and omissions insurance, directors and officers insurance, and cyber insurance, those three policies are written on claims made policy forms. And all three of them have something called a change in control provision. when more than 51% of the company is sold, transferred, or merged, the policy is automatically canceled. A lot of people don't know that, and a lot of attorneys don't know that. And they just think, oh, we'll just continue to pay the premiums as the company. We're not going to change the name of the company. But the problem is that now you have no coverage. So we have actually a company that's owned by a parent company in Paris, a client that's their parents in Paris, and the parent company was sold. The U.S. company is part of the parent, is 100% owned by the parent, and we didn't know about a transaction in France until 3 months after the fact. Now we're like, oh crap, now what do we do? So we've got to rewrite a whole bunch of policies. Not a big deal. But the only reason I bring it up is that it's really the only other insurance matter that comes up. And a lot of it policies, like even property liability, are not assumable. Workers' comp has to be adjusted. So that's where I've kind of worked in part of the deal team to do the diligence, to do the transaction advisory, to get the right coverage in place from the seller to the buyer, let the buyer know, look, you got a problem here. They've never purchased employment practice liability insurance. There's a huge risk out there that there could be a claim that arises after the transaction. So that's kind of my take on it.
So
Gotcha.
basically what Gordon just said, as part of your due diligence process, you should always get copies of all of the policies, the policy documents, and review them for change of control clauses. Because again, if you're buying the business and from day one you start to operate the business and there's a lack of insurance, you've got some risk exposure there. Now, some of our lenders will require you to get certain policies for them to review, but I'd say, that's something that should probably happen way before you even go to underwriting with your lender. So that should be part of your ask request on your due diligence list, not the early due diligence. I don't want you guys going out there looking for businesses. Hey, I need a copy of all your insurance policies before you even make a decision on whether to buy the business. But once you get through the LOI phase of it, and you're into the actual due diligence part of the process, you should always ask for copies of all insurance policies on the business and review those policies, or have Gordon review those policies for you.
Yeah, because quite frankly, most insurance brokers don't know what's contained in that 150-page policy. That's where my expertise is understanding these policy forms and how they work and how they don't work, especially in change of control situations.
Yeah, you sound like a good guy to have on your side, my side.
Yeah,
I see the value on their side. You need to be on my side, so that sounds good. Yeah.
All right.
Gordon, if you have operating history in a different industry, is there any way to get that counting towards maybe reduced premiums in like a workers' comp or EPLI situation?
I think anytime that there's experience that's transportable from seller to buyer and the buyer has experience, I think an underwriter should know about it. And that's part of the negotiation process. So, just take a quick example, a manufacturing company and the buyer was in manufacturing and they know how to build a safety plan or a risk control safety plan. And we've got tools that help buyers do that. That goes into the rating factor if it's communicated properly to the underwriters. And that's what we do.
Thank you.
Boy, I love these questions. I can answer them.
Anyone else for Gordon before we let him go?
And anything I couldn't answer, I'll try to get answers to and get it over to Rich so he can communicate it.
Yeah.
All right, folks, it's been great talking to you and learning about your business a little bit. And if there's anything more I can help you with, drop me an email. I'd be happy to get on a call with you and talk about a particular deal or how we can help out and on the diligence side or really about anything with commercial insurance.
Well, thanks, Gordon, for taking some time to meet with us. I'm glad we've gotten to know each other for the last month and a half or so. And definitely we will be in touch.
Sounds good.
And hopefully we'll do a lot of business, even with Acquira internally with some of our portfolio acquisitions. We can work with you on those.
Sounds good. And I appreciate the invite and the time.
All right.
Take care,
Thanks,
everybody.
Gordon.
All right, bye.
Thanks a lot.
Thanks for everyone for joining. See you guys next week.